Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. I think this is an interesting and potentially timely discussion because we've had a great run on the markets since April. However, if we look at what the S&P has accomplished since about the middle of September, it ain't much. And in conditions like this, some traders' attention might turn to income strategies. So we're going to be talking through the pros and the cons of selling covered calls when stocks are struggling. I think it should be a really interesting discussion. Before we can get to that discussion, though, let me first of all say hello to everybody who's already joining us out there in YouTube in the live audience. Great to see so many familiar names. As always, hello there, Lawrence and Eva, David, Mark, Greg, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recordings. That's a great way to watch these webcasts, but also be aware that you're invited to join us in the live stream if you'd like to be here. This is a Monday webcast series. We kick things off promptly at 2 o'clock Eastern time. So we'd love to have you here as a live stream audience member. I also want to let our live stream members know that my very good friend Barb Armstrong's hanging out in the chats with us. Barb's going to be keeping an eye on questions that come in. If I can't get to those during the flow of the presentation, Barb's there to sort of pick up the slack for me. Barb and I have been working together for years, so I definitely appreciate your assistance there, Barb. And Barb and I would also like to issue an invitation to everybody listening. Follow us on social media. It's another great place to connect with your favorite presenters from Schwab in between the live streams, so you can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. Now, as of just a couple or 3 weeks ago, you can also follow me on LinkedIn. So if you want to find me there, go to linkedin.com/in and then throw on a /Cameron May CS, and that'll have you on the right profile. All right, but let's get right into this discussion. Of course, as we go to talk about covered calls and other strategies as well, please be aware that that investing and trading carry risk. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. I've already told you what the focus of the discussion is going to be. However, before we get to that, first thing that we'll be doing is following up on current positions in our example paper money portfolio. This webcast is part of an ongoing series of webcasts, and those earlier webcasts have included some example trades. So let's go see what's going on with those. Then we're going to see what's happening with the S&P 500 and why for some traders, it's been kind of an unproductive stretch here for the last couple of months, and why for some of those, they may be turning their attention to other approaches, including potentially income. So we're going to be talking about selling covered calls when markets maybe begin to struggle. We're going to be weighing the pros and cons of that. We'll be using a real-time example in thinkorswim on the desktop platform. And then before we're done, we'll plan and place a covered call trade on the platform. So let's go right to thinkorswim desktop. Here we are in the simulated trading environment. There are our example trades. We have 6 positions in right now. And let's have a look at these. So first of all, we have our Amazon covered call. Now, we'll look at Amazon's entire history here, but right now we own 100 shares, purchased for $221.52. Those shares are up a bit. Sold a 260 call, well above our entry price. That call has shrunk or contracted in value, which is good for that position. But overall, here's what's actually been happening with Amazon. We bought the shares back here, sold some calls along the way between our entry and the present day. Those have now realized gains. We popped up, sold a new call up here at the 260 level, but we've been retreating since then, and we had a plan that we've discussed in previous webcasts. We're going to exit this position if this previous resistance, this previous price ceiling, doesn't hold up as a new price floor. If that support breaks, plan was to exit. And you can see cameras are back on. And just a couple of days ago, we did break through that support. So time to take our lumps on this one. Lumps meaning we're not getting out at the absolute high. Obviously, that would be fantastic had we done that. However, this is a profitable trade overall. The shares are up from where they were, down from where they've been, but these realized gains and this unrealized gain on this call kind of called to mind the reason for today's discussion. I thought, you know what, stocks are not always productive. And at those times, some income traders try to supplement that underperformance by selling call options. So that's going to be what we're talking about today. But we are going to be closing this position out because that was the plan. So let's go do it. Let's go to our monitor tab. I'm going to right click on Amazon. Let's create a closing order to sell the entire covered call position, exit the shares, close out the call. Again, the call probably will be realizing a gain here of about $4.60-ish. We'll see. And the stock will be realizing a gain of maybe, looks like around $9 or a little bit more, but let's right click, create a closing order, sell that covered call. This is selling the shares and buying that call back. Looks like it might cost us anywhere between, well, it shouldn't say cost us. This is a credit transaction to close out a covered call. We might receive somewhere between $229.63, $229.60. Let's say we'd even settle for $229.55. I'm just doing this in the interest of trying to get a quicker fill while the cameras are on. We don't have to stall around and wait to see if this order will fill. Hopefully it'll fill quickly. But anytime we use a limit order, there's certainly a risk the order might not fill. Okay. Mark is saying we could also just submit this as a market order. Yep, we certainly could. Obviously, when a trader does that, they expose themselves to sort of the whims of the marketplace. However, it does elevate the potential for a quick fill. So there are pros and cons. But let me click confirm and send here. We're going to sell out of this covered call position. Trying right now to pull back $22,955 into cash. There is a commission to be paid on this transaction if it fills. Let's send that off and see if we can get that filled. I would suspect that we can if we go to our working orders. Yeah, looks like we filled at $229.61, sold the shares, closed the call, flattened that position. So that was nice. We've now realized $9-ish on the stock. We've probably realized around $4.50 on that short call option that we're in. That's in addition to some earlier incomes that we realized. And that's where the trader, even when a stock isn't doing as well, sometimes that income can assist with that performance. So Amazon's been a nice trade. Let's have a look at Broadcom. The Broadcom position not doing so well. We're not going to be doing anything with this today, but bought 100 shares and sold a call against that. So if we look at the Broadcom, this has a pretty short history right now. Bought the shares here, sold a short-term call for a profit, sold a little bit longer term, pushing out here to the expiration right before that earnings announcement, sold that for $5.85. Price has been pulling back there, but I think kind of interestingly, we've come down to a longer term, this sort of intermediate to longer term trend line, possibly finding a support there. And we're still above the gap up right here. So let's hang on to this. Let's let it continue to work. But we are a little below the break-even point on this trade. 352 is break-even. We're at 343 and change. I should say 352 and change is break-even. 343 and change is where we are. We'll see if we can get a bounce off of there. We'll come back and revisit that in a future webcast. Let's have a look at Bank of America. Also with this one, we're not going to be making any changes, although it looks like the trader might be able to close this out for about 22 cents on the short call option. Here's what's happened with that. This is kind of interesting. So we bought the shares back here, sold a call for a realized gain of 107, sold the 21st of November 53 calls. So we're still looking over the horizon a little bit at that one. This trade, that went in the money. In a real account, that certainly elevates the risk of early assignment. In paper money, early assignment is not a thing. It doesn't happen. but it can happen in a real account. Had it occurred, well, we would have sold our shares that we purchased for $50.58, sold those for $53. That would be a realized gain on the stock. That would also realize the gain on the premium that we collected here, plus the premium that was previously realized. Overall, that would be pretty good profit with a break even all the way down there at 48.24. Right now, though, we've fallen back down out of the money on that short call. Actually, sufficiently enough that we might be able to exit for 22 or 23 cents. I'm gonna let this go one more week. Do we have time? Let's see. Actually, no, that looks like that before we get a chance to talk again, that one will either recover and get assigned or fall down and just expire. I'm going to let that one go. We'll talk about that, see if that turns out to be the right decision. Right now, there's still $23 per contract, about $45 overall that might be realized if we can just stay below 53. But even if we get assigned, that would be at a profitable level. So I'm going to let that one work. Microsoft, this was last week's discussion. We sold a put for a long period. Sold it for $23. It's worth $24 right now. So it's not doing exactly what the trader might hope. That's because Microsoft has come down. Let's look at that. So with Microsoft, here's our stock. We entered back here. The stock has actually come down a bit. Even a few dollars can pump up that price of our long-term put a little bit, but we basically sold the 21st of January of 2028, 380 put, collected $23 for that. That makes the break even all the way down here at 357. Yeah, Mark says we got to take a longer term view with leaps. Yeah, the trader here might just be waiting for, if we can just get one bullish swing sometime, maybe in the next few weeks, maybe in the next few months, it could really drag down the expense to get out of this short put. Maybe the trader is looking to get half of their $23. Depends from trader to trader. There can be differences of opinion there. But yeah, the general concept here is to try to get some sort of a bump upward. And as we're sort of hovering along a support, looks like that may happen. Time will tell. We're going to let that one continue to work. And before we move on to these last two positions, I do want to point out there's a survey that's been added to the chat window. So thanks for calling that out. I see even thank you for giving me the heads up each time on that. But if you've never filled out one of our surveys before, here's how it works. We get a random link that shows up in our chats. You click on that link, just sort of hold off on filling it out until the end of the webcast when you can give us some honest feedback about how you thought things went. I'll just let you know, though, they're very short surveys, 2 multiple choice questions, a comments box, and a suggestion box. And if you take the time to fill out that survey, just click for those 2 multiple choice questions. And if you leave comments, if you leave suggestions, I read through all that data. I read through all the comments and the suggestions, and it's never a wasted effort on your end. It always helps. Now, it doesn't mean I'm always going to adopt every suggestion that everybody makes, but I'm always looking to improve these things. So thanks for doing that. But back to our trades now. We have 100 shares of NVIDIA. Why isn't this a covered call? Here's why. Let's go have a look at our chart of NVIDIA. We bought the shares back here, 183.71, sold a 14th of November 195 call that went in the money. It went out of the money. It went in the money. And finally, it's gone back down out of the money. And we've hit the 14th of November expiration. That was Friday. Today's Monday. So it got, for those that might have been concerned about being called out, this could have been dicey. Getting called out is not always a negative outcome, though, if the trader doesn't really care. In this case, it would have meant that we sold shares for $195 that we purchased for $183.71. I think you can see that's not necessarily a negative outcome. It's not selling at absolute peaks, but that would essentially be a forced profit-taking scenario. But didn't happen. We weren't assigned. The early assignment doesn't happen in real accounts, so it allowed us to get all the way to expiration, and we just expired worthless. So maybe here we might go sell another covered call. I'm not going to do that because we sold the first one for a reason, and that was so that we didn't have a cap on the upside potential of our stock shares going into this earnings announcement. Some traders just have that preference, so that's what we did. We made sure our contract expired before that. So we're not going to change that. We'll just leave those shares, see how the earnings go, and then look to see what to do with those after the earnings. So next up, and finally, is our Visa trade. We own 100 shares, sold the 355 call right now. Preference is for the stock to go up toward 355, but stay below there if we don't want to get called out. So here's what's happened with Visa. We actually bought those shares all the way back here. If you don't know the history of our Visa trade, we sold some puts and they just expired. Okay, so we sold some more puts, collected a premium there. That was a realized gain on that premium, but also we were assigned the shares for $330. So here we are at 330. We just broke down through 330. That means we lost money, doesn't it? No. Actually, overall, this is still a profitable trade due to our break-even level being lowered by the premiums that we've collected along the way. And this really ties nicely into today's intended discussion. When prices aren't delivering profits to a trader, can income step in and play that role? In some cases, it can, and in this case, it did. So we've realized gains here. We've realized gains here. We realized profit on these calls, realized a profit on these calls, or on this call is a better way to put that. And now we've sold the 355 call for 267, and I think we're in position to close that out for a profit as well. Yeah, with the price falling like this, certainly we are. Let's go have a look. Sold for 267. It looks like, I shouldn't say certainly, I guess there's always a chance for something weird to happen. All of a sudden the liquidity dries up, we can't get out, something like that. But setting that aside, yeah, it looks like maybe another $1 and change that we might realize and gain here. So let's close this out according to the original plan, which was to close the position if support broke, and it has. Sounds terrible. Bought the shares for 330. We're selling for less than that. Bad. Didn't make any money on the shares, but we've made money on the income. So let's close this out. Right click on Visa, create a closing order, and sell that covered call. How about we do what Mark proposed a little bit earlier? Let's just close this one out the market price, because I like to highlight things when we make decisions like this. This is literally telling the system, hey, sell the stock for whatever we can get for it. Buy that call for whatever it takes to buy the call back. Can you see some potential concerns with that? Yeah, we might not be thrilled with the price received for the shares sold. We might not be excited about how much we have to pay to buy the call back. But let's see. Let's click confirm and send. Let's sell that covered call at the market price. There is a commission to be paid to close out that short call position. Let's send this off. See how we did. Okay, there we go. Let's see what we netted here. So remember, we sold the call for 267, bought the shares for 330. How did we do on this last bit of this transaction? If we go up to today's filled orders, our 355 call, all right, we made about $1.30 on that. The stock, we lost about $2.19. Overall, it was the income from that strategy that carried the day. Turned a loser into a winner. That's what I intended for today's discussion to be all about. It doesn't mean that every time a trader turns their attention from price appreciation to income that we're guaranteed success. Nope, that's not the case. But in this case, it worked out. So let's go have a look. Mike says, how can I see my call gains and my break-even price on Thinkorswim? Thanks. So Mike, you can go to your trade, you can go to your history and sort by symbol. So on your monitor tab, you can see the statement for your trades. So for example, if I wanted to revisit what we've done on, we just closed out Visa. So let's bring up Visa. I can set it back for a certain number of days. How about we just go back to when our Visa trade started? We started that. Well, that was a long time ago. So yeah, let's just leave it at 365 days here. And if I look at my trade history, I can see all of the trades involved in this. So let's go have a look at what's going on with the S&P 500. Actually, hold on a second. I want to make sure I didn't skip something. No, okay. Back to the S&P 500. This line is what I wanted to talk about because this line's kind of exciting. If we look at what stocks have been doing, I know it's been kind of fun looking at those 401k balances going up and up and up and up for most bulls in the marketplace right now. It's been a nice run since April. But if we look at the S&P right now, and as a matter of fact, I could redraw this line. Let me just clear things up. Let me right click on this. I'm going to activate this drawing and pull it down to where we are right now. And notice where that carries us back to, going all the way back to September 19th. The markets have been up, the markets have been down, the markets have been up, the markets have been down, but boy, that is sideways. That is choppy, resulting in zero appreciation for the average investor of the S&P 500 over those last couple of months, at least stretching back to September 19th. So that can be a frustrating time, but obviously traders recognize that sort of thing just happens. And so for some traders, they can just wait it out. Now for others though, who might be a little bit more, let's say, proactive by nature, recognizing that there are going to be trade-offs if they pursue what I'm about to talk about. Some traders might say, you know what, I'm done with trading. I'm done with waiting. Let's maybe shift our focus from appreciation in price, which doesn't seem to be working at the moment, to income. And shares that are not delivering returns in capital appreciation, maybe those can deliver income potential. So let's do that. Let's see. And Jay Taylor, it's just talking back and forth with somebody else. That's okay. Let's go have a look. Mark says VIX is showing a strong upward move today. Great. Mark, I actually wasn't planning to talk about VIX, but let's have a quick peek. You say it's currently above 22. So for an income investor or trader selling covered calls for income, this might be an important development. So let's update my drawings here. Let's remove this one. Let's move this one up. This is where we find ourselves right now. What does this mean for the income trader looking to sell calls for income? Well, when the VIX, or the volatility index of the S&P 500, rises, typically premiums on most stocks at most strike prices go up. Yeah, options become more expensive, which can be a good thing if we're looking to sell those. What that literally translates to is that on many strike prices on a lot of stocks out there right now, those premiums are higher than they've been, with very few exceptions, over the last 6 months. All right, Mark, maybe you just add a little bit of fuel to the fire here today. But that is an important observation, because why do options traders care about a volatility chart of the S&P 500? Well, when volatility rises, some traders see that as carrying greater potential if they're out there buying calls or buying puts, and so they're willing to pay more for those options, driving the prices up. For the seller of those options, it means getting larger premiums. Okay, so let's go have a look at an example stock today. With that as sort of the stock backdrop and the options market backdrop, let's go see what's going on with a stock in our portfolio. Here's one that's been quiet it's not been quiet, it's been sitting there for a long time. Let me close up the today's trade activity area. And I want to look down here toward the bottom of our example portfolio. Here we have some shares of Alphabet. We purchased 100 shares back at the first part of the year. And that was for a different discussion, for different motivations. We just bought them and then we just ignored them. It wasn't even in this webcast. I have other webcast series, and this one was purchased in another webcast series, and then it was just left to do its own thing. Well, that's what happens in portfolios a lot of the time. We just buy shares, we hold on to them, and then off they go. And in this case, the stock has gone from 199 bucks up to about $285. Let's go see what this is doing right now. So like so many other stocks, but actually starting, no, it's actually about the same time. I was going to say it started earlier. It didn't start earlier. Right about that same time in April, Alphabet started to take off. Here's when we bought those shares, right back there. So our portfolio did this with our Alphabet shares, and then it's done this with those Alphabet shares, and they've gone up and up and up and up. It's been a brilliant run for owners of Alphabet. However, look at the last month. Stuff has gotten choppy, and it looks like there may be a near-term price ceiling at about $293. Looks like shareholders have just been reluctant to allow prices to go above $293 for whatever reason. So let's just say that we are that hypothetical owner of shares of Google, and we're thinking, oh, this run has been great, but right now price appreciation isn't working like it once was. Maybe it will be, maybe it will start up again, but let's just say that our trader thinks that for a little while, for not the foreseeable future. I don't like that word because we can't foresee the future, but I mean, we can look and recognize that there are some weeks ahead. Let's just say that their anticipation is, their expectation is the stock might struggle to get above that 293 for a while. So they could just sit there and do nothing with the shares, and hopefully we break above that resistance at some point. Or let's say they choose to sell a covered call. That's what we're going to do today. Let's go sell a covered call on this Alphabet position and talk about the pros and the cons of doing this as we do it. So I'm going to go to the trade tab. We know that we own 100 shares. That allows us to sell one contract if we want a covered position in this portfolio. And if it's helpful, I have created, let's just do this while we're at it. I've created a group to sort of put all of our covered calls and short puts positions together. And since we're going to be doing a covered call on this, let's move Google. Let's move that to our covered calls and short puts group. So that now is, it's no longer unallocated. It's been allocated to covered calls and short puts. So let's go sell a call. And let's say that our trader thinks that maybe that resistance might hold us through the early, well, the sort of the latter stages of the Christmas season, I should say, up to about December 19th. All right. So let's say that our trader might prefer to not sell the shares, but if the stock does rally, maybe they're okay with selling the shares at some level above 293. Let's go to the trade tab, see what that translates into in real life here, in paper money, in real time, I should say. Let's look at the 19th of December contracts. And I wanted to put a rule of thumb out there just as a hypothetical, because I get questions all the time, Cameron, how do I choose which strike price, which contract to sell? Let's say I've selected my expiration. Well, now which contract do I sell? Because I can sell pricier contracts for bigger premiums, but that requires that I sell the stock at a lower price. I can sell less expensive contracts, smaller premiums, but it allows me to have more wiggle room to the upside in the shares. So here's a rule of thumb that some traders will use in an effort to address that question. And that is, let's say they're looking for at least or around 1% of the current value of the stock in the form of the premium they're collecting. Here's what I'm talking about. If our stock is trading around $285, maybe they want that premium to be at least 1% of that, which would be around $2.84-ish. So let's look to see what's on offer. And it looks like the 315 strike is only a few pennies shy of that at the moment. 277 to 281. Let's say we can get 280 for that. We don't know for sure. But if we're able to collect $2.80, well, that's right, almost bang on 1% of the current value of the stock for a 32-day position. Or in other words, someone is paying us 1% of the value of the stock for the right to buy our shares for $315. Ooh, that's actually $30 above the current price. So I think that's what we're going to do for today's example. And some people say they like it when I do this. So let me put this on here. I'm going to draw a line above today's candle up at $315 to represent this contract, not an oval. Let me remove that. Let's come down here and switch up our drawing tool. I'm going to go up and draw a line right at 315, or as close as I can. What I typically do is I'll draw my line, get it relatively close, and then I just edit the properties of that line. Let's edit that. I want that line to start at 315, and I want it to end at 315. Let's start it today, November 17th, and let's end it December 19th. That's expiration. I'm going to change the color to red. Red isn't intended to be good or bad. That's just an indication to me that we're selling a contract at that level. So there we are. So that just represents this call that we're considering selling. And it gives us a visual that if the stock does break this resistance, if it moves its way up toward 315, but as long as we're below that level, this trader's still in position for allowing that contract to expire worthless, hopefully delivering, this is what we're hoping for, delivering a realized gain of up to 1%, depending on the circumstances of the exit of that call. 1% potential return if the stock stays below 315. If the stock ever does, if the contract gets assigned, oh, hey, we wound up, in that case, selling the shares at $315 that we purchased a long time ago for $199. That's pretty good trade if that's the way it goes. Now, here's the benefit in today's market conditions. Let's talk about pros and cons of this. So as we go back here, let's look at our trade. I'm going to go ahead and place this trade, but I want to talk about the pros and cons as we do it. So I'm going to click on the bid price. As long as we're doing this selling transaction in the same account where the shares are held, we don't need to designate it as a covered call or anything like that. We just need to sell one call for the 100 shares that we own in that same account. We're going to sell the 19th of December 315 call. Let's see if we might not be able to get 280 for it right now. We might have to settle for, let's say, 270. We're going to come a few pennies short, most likely, what we'd like to get. But let's say we want at least 270. Well, here is the potential benefit of doing this trade. If the stock decides to waffle around for a while, let's just say it just doesn't do anything, much like our Visa shares just didn't do much for us. Bought them for 330, they went up and down, and we sold them for 328. That's not doing much. Well, by collecting a premium, we now have an income that goes into the account and nobody can take it from us. That's the potential advantage here. If we're able to get $2.70, let's see exactly how much we get. Let's finish this and then I'll finish my thoughts. So there is a commission to be paid on this. We're going to see if we can get 270 and let's send that order off. Did the price move on us? No, that's still looking favorable. If we go back to our monitor tab, we look at our working orders, we're only asking 270. The market price is 275. I think that's going to fill here pretty quickly. There it is. So we sold for 277. So here's the deal. We just had a $2.77 premium paid to this portfolio. So as long as the stock doesn't fall further than 277, the income from this can help to mitigate some of the downside risk as our stock sort of waffles around. Now, if the stock absolutely collapses, the 277 is going to feel like, not much of a consolation price. But income does have that potential to deliver returns or at least reduce risk exposure when stock starts to waffle sideways. We've already seen that on our example trades today. So those are the pros. Income comes up. What's the con here? Well, there's a trade-off here. We're not getting this for free. Someone does have the right to buy our shares for $315. So the trade-off is that for the duration of this contract, for as long as we're in this contract, there is a conceptual gap on how much money we can make. On the shares, we can only make about $30. That's in addition to the $277 that's already been collected on the premium. So really the upside potential is limited to about $300 Well, it would be the equivalent of exiting for $317.77. That's a 315 exit on the shares of stock plus 277 from the premium of their income from the option. All right, let's see. Any questions that have come in here today? See if I'm missing anything. If the stock were to rise higher than the covered call price, would you consider rolling the call to keep the underlying stock and not getting called away? And sometimes we do. Sometimes we do that, E. Dunning. Yeah. So here's the question. Let's say our stock doesn't really encounter much resistance at all. Let's say the stock just decides to do this. It goes running up, and our trader goes, "Oh, geez, I know I got into a contract that said someone has the right to buy the shares from me for $315, but I don't really want to sell for $315. Well, if the contract has not been assigned yet, the trader may choose to attempt to roll that contract. And what a roll just means buy out of the contract that we're in and use the same order ticket to get into some other contract with a different set of obligations. Maybe instead of being obligated to sell our shares for $315 at any time through December 19th, maybe we get into a subsequent contract through the mechanism of a roll. Maybe we roll that up to $320 or $325 or $330 or whatever. There are pros and cons to that. If the stock has gone up and it looks like someone's about to buy the shares for $315, or maybe they could, it's probably going to cost more to buy out of the contract than $2.77, the amount that was received up front. So we may realize a loss on that exit. And the new contract that we get into carries no guarantee that it's going to work out any better. So there are potential risks to doing that sort of thing. Obviously, if we roll and we close out our first contract, the advantage to that is if the trader didn't want to get assigned and they do that before assignment, maybe they can push off the likelihood of assignment. So maybe they accomplish that, but you won't see me do that very often. Most of the time, if the stock goes in the money, we let it get called out. That's just sort of a forced profitable exit if we've sold a strike that's above the price that we paid for the shares. And in this case, it is way above the price we paid for the shares. So that's a really good question, but I'm not going to do that probably for this position, or it's unlikely I'll do that for any position. And now it's not to say that there's no validity to doing that. It's just not the way that I typically do it in this webcast series. Mike says if the stock dumps, no longer makes sense to sell the calls. What are the options? Sell shares? Can we buy more shares? Yeah, Mike, both of those are legitimate potential ways to handle that. So what if the stock doesn't go up? What if it does this? Let's activate our drawing and go take it down here. So we sold this contract at $315. The stock starts to go down. Well, great. There's very little likelihood that that contract will be assigned. If somebody did, they'd almost be doing the trade. Well, not even almost. It would be doing this trader a favor in most circumstances, overpaying for the shares. That's unlikely. So now the stock's looking like, okay, the contract's not going to be assigned, but we own the shares and we're getting hammered. Yep. As the owner of the shares, if we have $2.77 in income, but we're losing money hand over fist on the shares, that income it's, as I said earlier, it's small consolation. So what might we do here? Well, the trader might just decide that's enough. Let's just buy the call back for whatever it costs, probably a fraction of what we received, and sell the shares. Just be done. That's one potential way to handle that. Another way is to let the contract expire and then hope that the shares just recover. That's another thing. For some traders looking to do something like dollar cost average, maybe this is just an opportunity to buy in more shares at a lower price, not lower than the original entry probably in this case, but lower than prices have been more recently. So which one should the trader do? Totally up to the individual trader's preference. Yep. Okay. So the question just came in, when and if. So when or if, or when, yeah, anyway, you get the point. If the covered call goes in the money, do you roll in the money covered call if you still get 1% in extrinsic in 30 days? If the trader has that rule for themselves, and I only use that as an example, let's say our trader wanted at least 1% on the premiums being sold. It's up to them on the new strike selection. What they'll be doing is balancing, well, what's the likelihood of assignment? Do I want to be assigned? And what's the size of the premium that's being sold on the new contract? Let's see. Mark says I'd be inclined to just buy the Google covered call back if it falls below 260. So Mark's saying if the stock fell, maybe he'd just buy the contract back, but hold the shares. Right? If I'm interpreting that right, Mark. Okay. And that's up to the trader. But I think for now, this is going to be our plan. And what some traders will do is, this is the way to just sort of frame the entire trade. The income is $2.77. Let's put that in real terms here. The stock is $284. The income is $2.77. We're literally dealing with 99% of one and 1% of the other. Which one do you think carries the most weight? Probably the stock. If the stock starts to misbehave and if the trader no longer wants to be the owner of those shares, that may be given preference. So if the stock is, let's say, breaking down, they might just buy out of the covered call and exit the stock. And that'll be our plan here. If we start to see, let's say, a technical breakdown in price, we'll just close up the whole thing. So how about very recently, that might be lows around here. Let's keep an eye on that support. And let's make a note to ourselves. I'm going to use the kind of squishy word, consider closing if word breaks. There we go. And we'll talk about that. So I like to talk about instead of just saying, okay, that's it, we're done. I like to talk through the pros and the cons of anything that we do before we take the action. So that'll be our plan here, but we're in our covered call. Let's, you'll notice when I went and sold that call wound up down here in the unallocated. The stock is up here. Try this one more time. Stock is up here in the covered calls area. So it says a split position. As it's positioned to split, let's unsplit it. Let's make it whole. Right click. Let's move this call position, covered calls and short puts, and it's no longer split. We now have the entire position up here. There we go. All right, guys, we've done what I set out to do today. I wanted to talk through why some traders will turn to an income strategy like selling covered calls when stocks or when the markets are no longer delivering returns just in the form of prices appreciating. So there are pros and cons to that. We try to do balanced discussions here, and we've illustrated that using a current trade. So we'll see how this one goes. We'll see if it breaks support or if it goes up, maybe gets called out at that 315 level. Both of those are potential outcomes, or maybe we just manage the trade in between. But I hope that you'll join me in this Monday webcast series next week. We'll be following up on these trades, but also be aware of the full range of educational resources that are available to you from Schwab Education, starting with, if you're new here, make sure that you've subscribed to our Trader Talks channel on YouTube. So the full name of that channel is Trader Talks Schwab Coaching Webcasts. So this is where we house our previous webcasts, and you can also join the live streams here. For example, if you wanted to find previous webcasts from this series, you go to Trader Talks Schwab Coaching Webcasts on YouTube, click on playlists, and there are a bunch of playlists, a bunch of different webcast series on a range of topics. This one is sort of down toward the bottom. It's third row up from the bottom right now, trading covered calls and short puts. Let me click on view full playlist, and there we can see last week's discussion, that longer term put that we sold. You can see the logic of that trade. But I also want to let you know, if you have an account on X, you should be following your favorite presenters there on that platform. A great way to connect with us is on social media. You can follow Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. And if you reply to one of my posts here, I try to reply right back to you. Current question that I have going right now is, according to recent poll data, many Americans consider 63 to be the perfect retirement age? What do you think? What age are you targeting for retirement? So that'll be interesting to see what my followers have to say there. I have a similar question on LinkedIn. Just in the last couple of weeks, you can now follow me on LinkedIn. So look for linkedin.com/n/Cameron May CS. That's my profile there. Give me a follow there. And I have a poll going. Same question. So a couple of different ways to follow me now. Guys, that's going to do it. I'm going to let you go. Go fill out that survey. I will read through that data. That's always appreciated. Thanks to everybody who's already clicked the thumbs up. I can see over 100 people watching the live stream, and I can see how many people, 49, almost half already clicked the thumbs up. Thanks for doing that. That's very much appreciated. But guys, I'll see you in a future webcast. I'll look for you on social media, on X and on LinkedIn. Whenever I see you again, though, I want to wish you the very best of luck. Happy trading. Bye-bye.